Welcome to Right on the Money, the weekly talk show with interviews you can use to help you maximize your money and optimize your financial future. Before moving forward with any of the ideas discussed on the show, always consult your financial advisor, insurance professional, or tax consultant. Looking for financial help or a second opinion? We can help you in your search. And now, your host of Right on the Money, syndicated financial columnist and money-colored commentator, Steve Savant.
In this segment, we're talking about distribution options and how to shop for income with Liz Cornell, author, popular platform speaker, and certified annuity specialist. You know, there is so much in annuity. You got to be a specialist. Huh? I mean, how can you keep track of all this? It seems like it's a really deep subject.
Oh, yeah. I use the analogy, you can't be an expert at everything. So I live, die, breathe, and sleep by the annuity contracts, the insurance industry, and I absolutely love it. And so, yes, I specialize
now,
in
you
just
partner
that.
with a lot of advisors because you don't do money management. You
Yep.
outsource that to the other people who maybe do long-term care. You outsource that to other people. So your area, your niche is really annuity income.
Yes, absolutely. And I'm not one of those two. Every investment serves its purpose, whether it's an annuity contract, a stock, a bond. They all have a function of what it is that they do. It's a matter within your own preferences, picking and determining what things you want to do.
Well, here's what I want to do. I want to talk about income in this section, and I know there's a potpourri of way to play here. Let's talk about the three basic ideas. Single premium immediate annuity. This is for a person who knows that they're going to need money right away. I'm not saying it's good, it's bad. You have to do the math for yourself, but you're going to get it, and you're going to have that money within about a year. I might want to do a deferred income annuity, which I have to wait for a year before I can take it out. And I'm just looking at different options, guaranteed withdrawal benefits, a rider. These are three different ways I could actually start generating income.
Yes, and each carrier, each product, each company prices those products for doing something specifically. Again, it boils down to your personal preferences.
Liz, I'm going to stop you there because I'm curious about this. All these companies are fishing out of the same U.S. debenture pool. They're all buying U.S. government, for the most part, high investment yield bonds. I mean, they're usually investment grade. So everybody's fishing out of the same pool. So why is the income for like a 10-year certain or maybe a life annuitization, why do they all differ from carrier to carrier?
Well, each company has their own philosophy and in how they want to price things for even their general account, what they want, which is what essentially your money goes into. It's like a bank CD. You give your money to the bank, they have it, it goes into, say, a general account, and they lend it out so that somebody can purchase a car, get a mortgage, or they want to get a business loan, et cetera. It's the same kind of concept on the annuities. Yes, it's your money. You put it in there. It goes into their general account, and that's what they're reinvesting in, exactly what it is that you're talking about. But each company have their own actuaries, and they all have a business philosophy, whether it's short-term, long-term, and how they want these products specifically within the product portfolio that they offer, what they want each of them to do.
Well, I find it interesting. About a year ago, the United States government, and this was their idea, not ours, actually chose deferred income annuity to be part of the QLAC scenario, which is qualified longevity annuity contract, to give people the ability to defer and delay portions of their RMDs for retirement. To me, mind-blowing.
Yes.
This is a government's idea. We didn't bring this up.
Yes. Well, I think the government's just finally catching up to what is actually a really good idea.
Well, think about this. We'll walk through this. If I have a deferred annuity, this is just one income option. If I have a deferred income annuity, I don't have to buy it in one contract. I could actually buy it in sequence. Like, hey, I'll start the next one at 70 and for the rest of my life, or maybe 75 in the rest of my life, and start another one at 80. I could go all the way out, according to the regs, I could go all the way out to 85 and do this. That blows my mind.
And I call that comprehensive income planning. They cannot price everything into a product, meaning you can't get a 25% rate of return every single year and it be liquid and never touch anything when you go to take money out and pay for the kids and the grandkids all to go to college and, right? So annuities are the only thing on the planet that contractually guarantee this income. That's why they're considered insurance products,
well,
right?
I know of no annuities paying 25.
Yes, no, annuities do not pay 25%. I'm exaggerating, but I'm using that for an example. But yes, no, they don't pay 25%, but annuities are the only things that contractually bound and contractually guarantee. And quite frankly, the insurance industry has been here for a really long time, and they've been really successful at doing this.
No, well, now that I brought it up, right, I wanted you to talk the difference, because I think this is a contention issue among consumers. What's the difference between my payout rate And what am I really making rate of return?
Yes. So circling back around, we had talked about this a little bit earlier. You have three basic types of annuities. Okay. If you strip all of the fluff away, you have fixed, indexed, and variable annuities, right? Variable annuities are primarily invested in mutual funds. It's kind of like a brokerage account wrapped within an annuity contract. Fixed interest rates, fixed period of time, fixed annuity. Indexed annuity are fixed products because principal is protected. So you're not directly invested in an index itself. You are simply following it. The only thing that differentiates those three types of annuities is how your interest is earned and how principal is or is not protected. Now, outside of that, that's what your capital is doing. That's what your real money, your real dollars, when you get a statement and you say, Liz, how much real money do I have? Okay, that is dictated by which product it is or type of annuity that you have picked. Now, on the flip side of that, annuities also have these income guarantees. I use the illustration, and just as a disclaimer, this is solely to be an extreme so you can understand the concept. That it's like going to an advisor, a bank, or whomever, or just going to a person and they say, okay, Steve, you've got $1 million. So here's what we're going to do. We're going to guarantee that based on the current value that you have, this $1 million, that we will give you $60,000 a year, right? Or the payout rate. Now, in order for us to guarantee that we're going to do that, you may only get a 4% rate of return. Okay, so yes, you are getting more income than what it is that you are earning each year. However, as long as you are alive, if you live to be 150 years old, we are always going to give you that $60,000. And if you really want, you can pass that on to your spouse as well. In its simplest form, that is what an annuity is. Now, how you get that $60,000 is dependent on which provisions in a contract you want to use, such as in annuitization, whether it is that you want to utilize the free withdrawals. But most of them now have these guaranteed minimum withdrawal benefits, which take the old platform of these annuitizations. They guarantee the lifetime income it is that someone's going to get without someone having to make this permanent, irrevocable decision, so that if something changes, you can go back and get your money out.
Okay, so when there's some flexibility here that you're bringing up that is really something you need to look at. That's what I'm getting from our discussion. Okay, so now I'm looking at the ability of when I'm looking at how the distribution's made. I can ladder, I can use SPIAs, I can use DIAs, single premium immediate annuities, deferred income annuities, guaranteed withdrawal benefits. There's a lot to keep your head around. What about this issue about, I've noticed that some annuities sell for income, I have a roll-up rate or a kind of a bonus rate up front. What's that all about?
It could mean one of two things. A lot of annuities offer an upfront bonus, and yet it is an incentive from the carrier to buy the product, of course. They say, hey, Steve, you want to give us $100,000? We will give you, say, a $5,000 bonus. Yes, real money, real interest, real dollars, and that your account is real capital earning interest based off of the $105,000 versus the $100 you're giving in. Some semantics here, though, and a lot of times our people get confused talking about this roll-up rate. Guaranteed minimum withdrawal benefits, which we've touched on, are the income riders that are now available. Okay, it is the portion of the annuity that says no matter how your money performs or earns interest, dependent on the type that you pick, we will guarantee that for income purposes, and let me clarify that with my own clients, I use real money. You have real money and you have not real money. A not real money account, a guaranteed minimum withdrawal benefit, is basically, it's a phantom account attached to your contract, your real capital, your real dollars. It is a phantom account that is a calculation strictly for determining income. So I say it's semantics because a lot of times when you're reading through the contracts and the brochures that they give you, they talk about this bonus credit, and a lot of people think that that's real money, real dollars. It's not. It's a calculation for determining an income amount, and that's okay as long as you know that ahead of time.
Okay, so I just make sure I got it, straight here. So I'm taking my roll-up rate. So they say, hey, if you join today and buy our annuity, we might give you 6%, 7% bonus. But that bonus is only assigned to your total, which is only used for income purposes only, not actual cash surrender.
Correct. And again, it depends on carrier and it depends on product. Some of them, what's called your benefit base, when I talk about these phantom accounts, all it is, again, it's a calculation for determining income. So some products will credit you a real interest, real bonus credit to your real dollar amount at time of purchase, at time that you buy the product. The other side of that is that each year if you purchase one of these phantom accounts, you can get a bonus credit each year. But again, you have to read between the lines a little bit and understand that that doesn't mean that it's a guaranteed real dollar, real rate of interest each year.
Well, I have to say, I've seen some carriers charge for this. You will charge for whether it's on your phantom account or your real money, whole nother idea. Remember, if you're listening to our show on radio, iTunes, or a podcast, you can view the video version online at rightonthemoneyshow.com and request information from this segment. Well, that's our show for this week. I want to thank Liz Cornell for being my guest. But before I go, remember what the good Reverend John Wesley once said: make all you can, give all you can, save all you can. I'm Steve Savant. We'll see you next week right here on Right on the Money.
For more information on this week's money topics, just go to our website at www.rightonthemoneyshow.com and follow Steve's daily postings on Facebook, Twitter, and LinkedIn. When it comes to retirement, money management, small business, insurance coverage, college funding, or budgeting, we have the interviews you can use.